Okay, now we're coming to the third and final part of this chapter, and it has to deal with uh, the basic financial statements and how they connect with each other, how one feeds into the other. And there are four basic financial statements. Four basic ones, and you generate them in the order that you're going to see them now, and that's what the next slide is about. Let me say it this way. The very first statement that you generate is the income statement. And then you're going to take information from the income statement and incorporate it in the statement of owner's equity. And then you're going to take information from the statement of owner's equity and incorporate it in the balance sheet. And then the statement of cash flows is comprised of information from the income statement and at least two periods of balance sheet information. 2 periods. So let's identify or describe the fundamental aspects of these financial statements. The income statement is a summary of revenue minus expenses. Money brought in from sales minus expenses. You either have a net loss or net income. And it covers a period of time. It could be a month, a quarter, 3 months, 6 months, or a year. It covers a period of time. The statement of owner's equity tells you what happened in the equity section. You started with what the owners invested, minus withdrawals, and plus net income, or minus net loss. Now, net income, net loss are a function of, don't forget, revenue minus expenses. Revenue minus expenses is what the income statement is about. So you're going to take the net loss or net income from the income statement and include it in the statement of owner's equity. And then that statement of owner's equity provides information including the balance sheet. And there you have assets and you have liabilities and owner's equity. Now, the statement of owner's equity covers a period of time, but the balance sheet does not. The balance sheet is a snapshot of a moment in time, not a period of time. It is the only financial statement that does not cover a period of time. Let me say that again. The balance sheet is the only financial statement that does not cover a period of time. It is a moment in time. And of course, the statement of cash flows. Where did cash come from and where did it go over a period of time? And I'll say this now. Cash is not the same as net income or profit. Cash is one thing. Net income or profit, as some may be familiar with that term, are not the same thing. So the statement of cash flows deals strictly with cash. Cold hard cash. Where did it come from and where did it go? Now, so let's take a look at some of this. If you look at this right here, you'll see we start out with the income statement. You have your revenue, or sales, consulting services. You see the total there of $5,800 plus the rent revenue. Which is $300. And that gives you altogether $6,100 in revenues. Then you subtract the expenses and you come up with a net income of $4,400. Revenue minus expenses. See that? Now, you're going to take that $4,400 and you're going to use that in the statement of owner's equity. You started out on December 1 with no money, no investment. later that day, I suppose, you invested $30,000. That was your equity. And you will add the income, which is now your equity is $34,400, and you subtract the $200 that you withdrew, the owner withdrew. So now the new equity at 1 month later is $34,200. Now notice, remember, if you go back to previous slides, remember it said that you have equity minus withdrawals. The investment, the capital investment, $30,000 minus withdrawals plus revenue minus expenses. Well, plus revenue minus expenses is the $4,400. As I told you then, we expanded the equity section just to prove a point, but the revenue minus expenses is done separately on an income statement. And whatever that is added or subtracted to the equity section or the statement of owner's equity. Now, let's go back to the income statement. Had it been a net loss, you would subtract that $4,400. In other words, if that were a $4,400 loss, you would be subtracting it from the investment. So, and then you also subtract, you always subtract withdrawals. So now we have a new capital account, or new amount in the capital account of $34,200. Then you're going to take that and add it to or include it in the balance sheet. Now, if we go back over all the transactions that we took part in, let me expand this a little bit. We ended up with $4,800 in cash, $9,600 in supplies, and $26,000 in equipment. We still owe $6,200 because we bought some things bought supplies on account, and we only paid $900 toward that, $7,100 if you recall. And now we bring down the new capital. It's no longer $30,000; it is $34,200. And you see here, assets of $40,400 equals total liabilities and equity of $40,400. Now, I want you to know also a couple of other things. One, the income statement covers a period of time for the month ended December 31. So the income statement covers a month, a period of time of 1 month. So does the statement of owner's equity. But notice the balance sheet. It's a single day, December 31, not a period of time. But you see how these statements are connected, how they link, and you always start in this order. Income statement first, statement of owner's equity next, balance sheet, and then or thereafter you're going to do the statement of cash flows. Notice how the heading is, the name of the company, then the title of the financial statement, okay, and the period of time. It could be a year ended, it could be the month ended, the quarter ended, whatever period of time you're talking about, you will note that, except for the balance sheet, which covers a date or moment in time, as I said. Next, as you see here, we got our statement of cash flows. Now, you won't learn how to do this in this class. What you are expected to know is how to set up and construct an income statement, a statement of owner's equity, and a balance sheet. You must know how to set up those statements. You will not be required in Accounting 1800 to construct a statement of cash flows. You'll learn that in Accounting 1810. But notice something here. Again, to show the interconnectedness of these statements. The very bottom line of the statement of cash flows, which covers a period of time also, we have $4,800. That's how much cash we have at the end of the period, and it matches the cash balance in the balance sheet of $4,800. If it does not, you've made a mistake. The cash balance on the balance sheet should match exactly the cash balance at the very bottom of the statement of cash flows. So, as you can see here, this is the order. Income statement, statement of retained earnings is the same as the statement of owner's equity. Okay? I took this slide from another book, and that book dealt primarily with corporations. And a corporation, we call it the statement of retained earnings, but it provides the same information as the statement of owner's equity, or similar information. Then the balance sheet, then the statement of cash flows. Okay, now, once you've generated the financial statements, you now have to do some analysis, conduct some analysis. One of the most popular methods or steps in analyzing the financial statement is calculating what is called return on assets. Now, this slide is in the book, and it provides you with the very basic, what I call the kiddie version of the return on assets. Net income divided by the average total assets. Do not use this. Do not use this. As I repeat this, do not use this particular ratio. Or at least, no, we'll use this ratio. Do not use this method that they are calculating return on assets. The next slide, I will show you the formula I want you to use. But let me explain some things here. ROA, or return on assets, means, in effect, for every dollar that you've invested in asset, how much is returned as net income. Again, return on assets means for every dollar that you invested or used to obtain assets, how much of it was returned as net income. So if you have a building, furniture, equipment, vehicles, and let's say you got $1 million worth of all of these assets on average, how much income were you able to generate using those assets? That's how much of the money that you spent on assets was returned as net income. Now it says average total assets, and whenever you see the word average, you have to cover, it covers two accounting periods. They describe it as beginning total assets plus ending total assets. I'll put it this way. You have 2 years. You have, let's say, the year 2018, what the assets were, total assets, and the total assets for the year 2019. Add them together and divide by 2. Net income is only for the current year, let's say 2019. So, let's say you have net income for 2019 and 2018. And you have assets, total assets for 2019 and 2018. To calculate this ratio, we're not concerned with the net income for 2018. This is the net income for 2019 divided by
It's 11:30.
Divided by the average total assets. The total assets of 2019 plus the total assets of 2018, add them together, divide by 2. It does not say average net income. It simply says net income, and there's always a net income for the most recent period. Now, as you can see here, comparing Nike and Under Armour, notice the trend you see from 2 years ago, 1 year ago, what's happening with the return on assets versus for Under Armour. The higher the number, the better, for the most part. The higher the number, the better. And in this case, you have So in other words, for Nike in the current year, you get a 19% return on assets. That means for every dollar invested in assets, 19 cents was returned as net income versus 7.9 cents for every dollar under Armour. Now, what's the formula I want you to use for return on assets? This is the kiddie formula here, but you guys are not kids. This is what I want you to use. Now, is net income, all we're doing is we're adding another portion here, and that is interest expense times 1 minus the tax rate. So, let me explain this. This imaginary company called Blueshaw had net income after taxes of $734,204. Then we're going to add to that, it also had interest expense. It paid interest of $110,755. The tax rate was, as you see here, 0.1845. So 1 minus 0.1845 is 0.8155. So 0.8155 times the interest expense, you get that number, then add it to 734,204, and then divide it by the average assets. Now over here for the most current year, the assets were $6,463,851. For the previous year, the assets were $5,716,025. Add them together and divide by 2, we get an average total assets, tangible assets, but don't worry about tangible right now, just total assets of $6,089,938. And the math should bring you to 0.14. If you don't get 0.14, you made a mathematical error here. Okay? So in effect, here's what we're saying, that for every dollar this company invested in assets, 14 cents was returned as net income after taxes. To do it this way, I have to give you this information. I have to tell you what the interest expense was. I have to tell you what the tax rate is. And don't forget, it is 1 minus the tax rate times the interest expense. The tax rate is 0.1845. 1 minus 0.1845 is 0.8155 times the interest expense. Multiply those two, then add it to the net income after taxes. Okay? Now, the reason why this is done this way is that because, well, I won't get into it. I give an explanation down here. It's to account for, taking consideration that different companies have different mix of debt and equity. And that affects net income. And you want to take that into account. Also, it also goes to how they finance the purchase of those assets too. So the interest expense and the tax rate are very important. The tax rate provides a tax shield because interest expense is tax deductible. Now I know that's a little bit more advanced in the explanation, but the main thing I want you to know is to use this formula. Don't use the kiddie formula on the previous slide. Use this one. Okay, now we're going to switch the subject just a wee bit. Explain the relationship between risk and return. And basically is this: the greater the risk, the greater return that you expect. In other words, let's take U.S. Treasury are securities sold by the U.S. government. Very secure. You're going to get your money. You're not going to lose your money. And that's why the interest rate is so low, because the risk is very low. Whereas some corporations don't have the best credit record, they have to pay a higher interest rate. Think of it this way: if you have very good credit and you want to buy an automobile, you can get a low interest rate loan. If you have bad credit, they're going to charge you a higher interest rate because you are considered a greater risk. And the people who provide the money for you to buy the car expect a greater return because you are a greater risk. If you are very low risk, then they're willing to lend you the money at a lower interest rate. Okay. And I want to discuss this right here. This has to do with the cash flow statement. Again, this will be covered more in detail in 1810. A company generates cash operating the business day to day, but also a source and use of money or cash comes from investing is also financing. Now let's explain these terms. Investing, when we're talking about a business, has to do primarily with buying assets. If a company buys a truck, that's considered an investment. Okay? If it sells that truck, it's also an investment, but it's a negative investment. It's an investment it's a negative investment. You're selling a truck that you no longer need, you're going to bring money in. So it's a negative investment. If a company buys a building, buys land, again, those are considered investment activities. Financing is basically the money that you may borrow or raise from investors to buy those assets, those long-term assets like land, building, and equipment. That's considered financing. And operating activities deals with, of course, again, the day-to-day operation of the business. And again, these explanations are very cursory. You'll get into more detail in 1810. Anyway, that ends it for this particular chapter. I'm going to upload this and try to make this work for you, and hopefully I've answered or addressed your questions, and we'll go from there. Take care.